I got to say one thing, and you're like, you know what, I'm doing direct investing because so many of you that I've spoken to have said I'm going to do direct investing. I would just want you to look at what you made on your direct investment and then stretch it out with all the empty months that you didn't have your money out and average that out and tell me what that return is.
Yep.
And then go look at what a MIC pays you and be like, wait a second.
Yep.
No risk, no work. And I could have made the same amount of money.
Yep.
Anyways, that's my take. Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal Andrino and Ryan and Neal. Enjoy.
All right, everybody, welcome back. It's episode 58 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, how are you today?
Doing good. Looking forward to lunch. Getting a little hungry.
Yeah, me too. Let's buzz through this. We got a lot to cover here, but we're going to talk about something that's close to home, I guess, for both of us, but primarily your role in investor relations in private lending. Yeah,
100%. Before we got started, you had sent over an article regarding some mortgage delinquency that you wanted to touch on.
I did.
I guess you can bring that up right now. I'm trying to remember what the headline was, but it basically, from my memory, it was Toronto mortgage delinquency hitting its highest rate in years or something grabby. I'm sure they ran it through that that title program where you put it in and says, how good is your title? It's like, make this more scary. Make it sound like all the mortgage market's collapsing. I mean, it wasn't mortgage, sorry. It was, I think, just...
No, it was arrears. Yeah.
Arrears, was it on mortgages? Or
it was on mortgages. It was.
Okay.
Yeah, so it's saying mortgage arrears in Toronto could climb to levels not seen in over a decade, CMHC has warned. Okay, so rising interest rates, cooling housing markets, increased non-mortgage credit delinquencies are putting homeowners under significant strain, and Vancouver is seeing similar risks with arrears potentially reaching 2015 levels. But a couple things, one thing I wanted to mention here is that the report actually suggested that Calgary, Saskatoon, and Halifax are going to maintain low arrears rates close to post-pandemic levels. Life's good for us. Yeah. We have nothing to worry about.
We don't need to cover this.
And it's saying Winnipeg also showed stability too, though recent declines in credit scores and increases in non-mortgage delinquencies could signal emerging risks. So this is primarily talking about, of course, the big urban centers, the Toronto and the Vancouver, potentially reaching those arrears rates in pre-pandemic, about 10 years ago levels where it was much worse. But and then, of course, there's the layered in portion driving a lot of this is the renewal shock that's coming in 2025 and 2026 with half of Canadian borrowers having to renew in that time frame, right? So I think that's not necessarily doom and gloom, but it's just something to keep an eye on. But again, interesting that it varies significantly by market.
What do you think impacts that?
The fact that it's varying by market? Well, I mean, it's the price points at the end of the day, right? Like the fact that, your average price point in Toronto is 1.2 million for a single family detached versus in Halifax, it's 500, right? Or in Saskatoon, it's probably 400 or 350, right? Like, obviously incomes are different in those areas as well, but not enough to justify a home that's 2 to 3 times the price.
Well, I wonder what the average mortgage size is in Toronto. But yeah,
700,000-800,000, I would assume.
Yeah, I wonder because
average.
I wonder if you look at the average mortgage size and then the increased take home, so where there's a bit of average income is higher, the average taxes are lower.
Yeah,
is it that much different? Or I guess it must be in some capacity.
It's got to be. Like, think of your monthly cash flow going on in that, right? Like, you're talking even a strong paycheck, you're still talking 40-50% of it going out to your mortgage payment.
Yeah, true. And because I wonder if
Property
it's partially a lifestyle thing too. Because like in Toronto, everyone's like, well, my house is $1.5 million. I think I deserve a Mercedes. And it's like,
and I saw another, I don't have the article in front of me, but I saw another report too saying people from like the greater Toronto area, like commuter areas like Hamilton that kind of comes into the city, they're not going out for dinners. They're not spending any excess money at all because their mortgages are so big and they have to allocate and keep their cash for that. So that's going to have other impacts on the economies too, right?
The other thought for me was, I think a lot of people like in Atlantic and Alberta, this is the first time we've had, I think, mass appreciation on real estate, but people here haven't, I think, been as aggressive to lever it up as they have. Like people in Ontario and BC are used to this. Like they're like, well, we've seen growth. Like there's an opportunity. There's a bunch of money here. We can pull it out. We can make more investments.
And mortgage lenders love it too, right? Because they see those as the most secure markets with the biggest population bases, and they're like, well, yeah, your property's appreciated from 900,000 to 1.5 million. Here's a line of credit for $500,000, right?
Let's stack it up.
Yeah.
So yeah, I think it might be a market, I don't want to say style, but just a way of operation that might be lending itself to be in a more risky position.
Yep.
Crazy enough, but
yeah, I wonder if we'll see dynamics shift out here as a result, but I don't think we're there yet.
Everyone's, I don't know. There's like, you get that 50% of people think Halifax is the next Vancouver. And then the other 50% like, there's no way in hell. And I don't know where I lie.
Yeah, exactly. Somewhere in between there, I think. But
yeah.
Let's talk about investor relations, Neal. And I want to kind of quickly outline the two major models that we've talked several times on this podcast in private lending. And that one being direct private lending and one being pooled funds or mix, okay? Or mutual fund trusts for that matter. So why don't you give us a quick overview of direct private lending?
Yeah. So again, same thing. We have talked about this a few times before, but that's where your funds as an investor are tied directly to a single mortgage. There's a couple different options doing this, but oftentimes you'll see, I think a lot of brokers will contact a client knowing that they might have $1 million in the bank and say, hey, I have another client that needs to borrow $500,000. We're going to put your money on there. You're going to charge a rate of 12%. And I'm going to take the fee for putting this deal together. So they might charge a 2 or 3% fee for putting the deal together. Sometimes it's as high as they'll offer even a portion of the fee to you. Maybe they're charging a 5% fee and they take 3 and give you 2.
Yeah.
But your money is directly tied to that singular loan, meaning if that person stops paying, you stop getting your payment. If that person defaults, you are now in the proceeding of default. And realistically, that is all your problem. The broker doesn't necessarily handle that. Some, I'm sure, better ones who do this a lot will help and be engaged and help you get through the process. But there's also, I'm sure there are others that'll just put you in that loan. Now it's your problem. They're not involved and you are chasing down that money. They're hands off. And so that's, and you might, it can be as much as like, it might be a white label product where your name's not directly on it and they're running it through their, we'll say, platform, that their private operation. Or some of them might have you literally directly being like, me, Neal Andrino, is lending to X Charles, like whoever it may be.
And I think that's what most direct private lenders would do, where the investor is actually listed on title on that given property rather than an investor in a private fund, right? There is some advantages to direct private lending, of course, too. There's I'd say, increased transparency, right? So the investor is actually getting an opportunity to underwrite the deal themselves, so they fully understand what they're lending their money on, and it can align that with their ability. Yeah, exactly, to the best of their ability. And that can align with what their risk tolerance is, right? Maybe they're high risk and they want to do 80% LTV, or maybe they're low risk and they want to only do 50% LTVs in urban areas, right? So, and of course, you can get higher returns, like you mentioned on this, right? So the higher risk can lead to better returns depending on the given deal. And then, of course, there's a bit of control there where you have the ability to basically choose deals on your personal preference, right? You can always say no if it doesn't fit for you and wait for the next one.
Yeah, 100%. Yeah.
And I think you outlined some of the challenges here. Obviously, this is higher risk than investing in a pool, right? You're not as diversified.
Exactly. The other thing that we have on here is this, obviously, there's a time investment that's involved. It's a larger time investment.
Of course.
Pooled fund obviously is much more passive. Like, you literally are doing nothing. This, you don't have to evaluate the deal, but you really should be.
100%.
Because your money, again, is directly tied. You are operating under a higher level of risk. You should be evaluating these deals yourself. The difficulty is, though, and this is kind of poking in there earlier, is even like being in this, like there's things I don't recognize or wouldn't pick up on that I see Zach pick up on just from experience in the game. He's like, just the way the docs come in, he's like, no, I know this is shit. Like
100%.
And like, I would have been totally fooled.
Absolutely. Right? Because the brokers bringing stuff into us, we've talked about it before. They want to sell the deal.
They're
right?
salespeople.
Yeah,
they're good
absolutely. They're very good at it. Very skilled. So that's a really good point. Is that it's the direct model is certainly active versus the pooled model is much more passive. So let's go through, Neal. Let's get an overview of the pooled fund or the MIC model.
Yeah, let's do that. Yeah, so a pooled fund, again, same thing. We've talked about this, but a pooled fund is as it sounds. You are investing into a pool of funds that are utilized to put out mortgages. So there is not you being directly tied to it. There is a fund or a MIC that is then underwriting and written on that loan. So their name is going on it and they're taking a lot of risk. You are then getting paid a return based on them charging their fees and their management fee, and then you receive the remainder of it. And now it's not like you go from 12% to 6%. Most MICs are probably charging you between 1.5% to 2.5% on management fee. And we'll get into what all that covers, but there is a lot that gets done for that process and a huge reduction in risk from my perspective again, where you might be spread over 60 loans. So if one person defaults, it has no impact on your monthly payment.
Absolutely. And I'd say, this is the model that we employ at Keystone. We're in the process of launching our mortgage investment corporation here in the next couple months. This is as basically as transparent as it gets from the pooled fund model. This is regulated by the Income Tax Act. You have to comply within those regulations as well. I don't want to call it institutionalized, but like this is like legitimized, I guess, the legitimized model in Canada that's preferred amongst the mortgage investment community would be the MIC model or the mutual fund trust model, depending on the type of structure that you're pursuing. But the MIC model is primarily focused on the residential space overall.
Yep.
So advantages of this model, of course, like we mentioned, you get the diversification. You've got exposure to multiple deals. In fact, you're exposed across the entire mortgage investment corp's book. And this significantly reduces the risk of losses on any single loan because, you could have a loss. Most companies, especially, with us, we're underwriting a deal so that we never have any losses on any given deal. But say you did have a $50K loss or $100K loss on a deal, the disaster happened on it, right? The investor's still not going to realize that because there's enough slack in the deal that pooled fund's going to make up for it at the end of the day. And then, the manager of Keystone or whatever MIC, they might take a hit on their return at that given period of time, but the investor's not going to see that hit and they're still going to get that consistent, steady dividend.
I'm going to be cautious in using this term, but it's like paying into an insurance policy in some sense of like, I'm giving up a % or two on this, but it's covering my ass.
Exactly. And some investors like that. Some prefer the higher risk model of the direct lending. We've seen people who, we're hoping are going to come into the fund and they say, nope, I want the direct tie to the deal. And we say, sorry, that's not how we operate here. So
I think it's a thing of a lot of people who end up being successful in life and or having extra capital have been very in control of their entire picture, their entire life. And they want to have that feeling of being fully in control with their loans, even though they might not necessarily be the most experienced or the most knowledgeable or be able to get the deal volume. Like there's a bunch of reasons why they might not be able to be successful in that.
Yeah.
But the idea of having that they feel like they have control over their money,
100%.
I think is where that comes in a lot. But
And we've kind of maybe mitigated that a little bit historically by just, with friends and family who are in our investment pool, by, providing them transparency through on a quarterly report saying this is the exact metrics. This is our portfolio loan to value. This is our average deal size. This is how many deals we did this quarter. This is how many were paid out. This is how many are in foreclosure. 0.
Yeah.
But so just very transparent. We go through deal examples and like I always tell investors too, like if you want more information, I'm an open book. Here you go. I can provide this information to you if you would like. And I just wanted to note as well, Neil, there is some MICs out there or other private lenders that do both.
Yeah,
they do the MIC model, like Hosper Mortgage, who hopefully we're going to have their principal James Grantis on here in the next little bit. But they do both. They have a MIC and they also do the direct funding model. Now, he said they also have to have a big team to manage the admin burn that's required for that as well, and that can be challenging. And I know they're I don't want to put words in his mouth, but I know that the preference for them is to have funds in the MIC as much as possible. Just much easier to manage that from that perspective, right? But that's just interesting that some places offer both.
Yeah, that is actually. I'm surprised that they would, but
I think it might have been a legacy thing as well with them. But hopefully we'll get James on and ask him this in the future.
People probably get a fair bit of money out on the direct side, and then one goes sideways and like screw this.
Yeah.
Also, because once you average out your return, you're like, wait a second, I could have just left it in the MIC and never had any any stress.
Exactly. Right. And that's one advantage too, being in a MIC model, is that there's no payouts when you're there, right? You're in and you're out. Like there's enough deals flowing through it versus if you're in the direct model, you're making awesome returns for those 10, 11, 12 months. But when that deal pays out, it might take you 4 or 5 months to find the next one, right? And then what are you getting paid? Your cash is just sitting there, right? So, the predictable monthly dividends you get through the MIC are obviously a key advantage. What about some of the challenges there, Neil?
Yeah, so on the opposite side, some of the challenges associated with it, and we've talked about this, is lower return. Again, I said earlier, it's not like a lower return in the sense of it being cut in half. It might be, let's say, 2 points lower than you were going to make on a direct. There are some direct loans that are going out at like 20% and above. That's totally different. That is a whole different marketplace. MICs aren't getting into those loans anyways. So that if you're comparing to that, I wouldn't say that's a fair comparison. But so you're going to be making a little bit less because lending fees are going to the MIC to the management group, and the fees that they charge are also being taken, but I would say you're maybe on average about 2% lower than you would be on a direct.
Yeah, that's probably fair.
Limited transparency. So you're not going to be seeing every single deal. It's not like, okay, now you're in, and every time we do a deal, you're going to get an email being like, we put money on this property, we put money on this property.
I feel like we lose half our investors at doing that.
Yeah, true.
Yeah.
And it's probably best that you don't, because there's certain things, again, that I think through experience, I'm seeing now there's certain loans that we get, they're like, this is a home run. And I think for a lot of people, if they were to see it, they're like, oh, this doesn't seem like a home run. But again, having had experience in putting out hundreds of millions of dollars and having done thousands of loans, you get a good feeling and understanding of who's a good broker, who's a good client, what's a good property,
Absolutely.
what's an actual true exit strategy. So anyways, you're not seeing all of that. And I think that's a benefit, but for some, they may feel like they really want to be heavily involved. Liquidity constraints. I don't know that this is a challenge as much. It's kind of a trick in the sense, like, you sign on with a MIC, and they have anywhere from, I'd say, 1 to 5 years. I haven't seen 10, but 1 to 5 year lock-in periods.
Yeah.
So they have an expectation. What that means is if you put in the money and there's a 3-year lock-in, you aren't allowed to access your capital for those 3 years.
Or you could be penalized if you do want to access it sooner.
Exactly. Or they'll might have penalties associated with removing it early. And that's why I say there's almost always a way to access the capital.
Yeah.
It's just there might be a penalty associated with removing it in advance. Again, I think you have less liquidity constraints, because if you're on a single loan, your only liquidity, well, 2 options, I guess, is you sell that loan.
Yeah.
So if you get someone else to take it over, and they're like, well, if they're not paying it back to you, then why the hell are they going to pay it back to me?
For sure.
I'll tell you right now, there's going to be a penalty on that if you sell that loan.
Absolutely.
The second thing is you're just waiting on that to pay out. That's the other option, is the borrower has to pay you back. And that could go great, but that also might not. And there's oftentimes changes. We all know how construction goes. We know how life goes. Things never just pan out exactly.
For sure.
And also, if you're in business, if you're like, fuck, I know I need this money in 6 months, I can almost bet my life for some reason it's going to go sideways by 2 months.
Yeah.
So anyway, so technically liquidity constraint is there because you've signed on an agreement to be set for a certain period of time. But then once you've broken that period, there's usually it's like a 90-day notice period where it's like, give us notice and within 90 days we'll get your funds back, which is reasonably liquid. I'd say it's even more liquid than a physical real estate asset.
Yeah, I agree with you, Neil. I challenge that the liquidity constraint is any worse in a MIC than it would be on a direct private deal, right? Because what if something happens on the exit strategy of that one deal, then your money's not coming back, versus MICs are generating tens or hundreds of deals on an annual basis, right? Where there's always money coming in and out. And chances are, if you want to withdraw it, it's going to be available to you within that 90-day time frame or whatever's the quoted time.
Yeah. And I think if you make an effort to make it a relationship with your MIC investment, there's it's not something that's going to be, if you know something's coming, you let them know and you work with them, I'm sure there's fairly reasonable opportunity to get your capital back.
Yeah, absolutely. So to wrap up, I wanted to go through some questions. So we're going through this right now, where we're moving from basically a small family and friends fund, a private issuer exemption, into the MIC model. So some of our investors obviously have questions through this transition. But before we go through some of those questions, let's just summarize kind of the key differences here to choosing the right model. So comparing the two, so obviously you get control versus convenience, right? So direct private lending offers more control, it's active, versus pooled funds prioritize the convenience, very much passive.
Mm-hmm.
Risk versus diversification, we talked about this. Direct lending has concentrated risk on an individual deal, while the pooled funds spread the risk across all of the deals. And expertise requirements. So direct lending requires investor knowledge on an individual deal or a marketplace or type of borrower, whereas the MICs are managed by experts. Ideally, you should always do your due diligence before investing in a MIC in terms of who the management team is, what their experience is. But ideally, you have a very experienced team who's done, like you said, Neil, hundreds or thousands of private loans and has shown that successful track record.
100%. And in our opinion, this is not financial advice,
of course.
But when do you want to choose to do direct lending, or when do you want to invest in a MIC? And so if you're trying to say you want to choose direct lending, you need to be an experienced investor who wants the higher returns and are very comfortable with risk. If you're someone that is more suited for steady returns, minimal involvement, and a reduced risk level, you should probably go with a MIC. I would say that that's a pretty quick way of saying it, but if you listen to everything we just talked about, that gives you a really detailed overview of why and when you would want to pick one of them.
Exactly. So Neil, let's wrap up with some questions investors might ask when considering a new mortgage investment corporation, which is what we are doing right now. So let's bounce back and forth on questions here. I'll start it off. They're going to, of course, ask about the company. What's the company's track record in private lending?
Yeah.
How experienced is the management team for the MIC, right? Why are they the right guys for the job? What types of properties or project does the MIC plan to invest in? Is it going to be residential? Is it going to be commercial? Is it going to be development? Is it going to be raw land? Are you going to be doing construction loans? All these are relevant questions you will likely face as a MIC manager.
Yeah. The next set of things that they'll probably look to learn about would be the fund structure and the operations of how it's run. So questions I might ask would be, is the MIC open-ended or closed-ended? Can new investors join over time, or is it fixed? How often are dividends paid, and are they reinvestable? And then what is the fee structure? Management fees, performance fees, any other applicable fees that an investor might have to pay for.
Yep. Risk and diversification. So how diversified will the fund be in terms of geography, property type, and loan size, right? Are you only lending in the GTA on residential properties? Or are you lending across all 4 Atlantic provinces and doing commercial loans or doing fix and flip loans, right? So you want to really understand this. What's the expected loan to value ratio for the mixed portfolio?
That's a good question.
Yeah, absolutely. That's a key one here. And what processes are in place for handling defaults or foreclosure?
The next part that you're going to probably hear, and this is the fun part for an investor, usually, is the return expectations. So they're going to be looking to know what the target annual return is for investors. And I guess if you're just learning about this is something that is, again, it's targeted. It's not never. Does anyone guarantee it?
I don't think you can legally guarantee a return.
Technically, you couldn't because So what's the target annual return for investors? How does this return compare to direct lending opportunities? That's one that I will say you'll hear a lot. I've been getting that fairly often in conversation. And then are returns guaranteed, or do they depend on the mix overall performance? Another good question I kind of alluded to earlier, but these are questions that I think you will definitely get pretty quickly. Honestly, this might be the first set of questions that you get from somebody.
Yeah, and just to kind of go a little bit further on that one there. So MICs typically have a targeted return. So say your targeted return is 8%, right? And then you go through the year, if say you're paying monthly dividends, you pay the investor 1/12 of 8% every month. And at the end of the year, say you actually were able to generate 8.75 or 9%. You could issue a special dividend at the end of the year to top up that investor, right? Or if for whatever reason you only delivered 7.8%, maybe that final payment of the year is a little bit lower than they would have got in that last month of the year.
Christmas bonus.
Exactly. Next up, legal and regulatory compliance. Is the MIC registered and compliant with all relevant provincial or federal regulations? And how does the MIC ensure investor funds are protected? And will investors receive audited financial statements or regular reporting, which in a MIC model, it's mandatory to have audited financial statements. So complete transparency on the financials on an annual basis. And often MICs, you don't have to have an offering memorandum, but many MICs do if they're taking on non-accredited investors or eligible investors. You need to have an offering memorandum. And that outlines any risks and outlines how the investor funds are protected and any other concerns an investor may have.
Yeah. So then some questions around liquidity and exit strategy. Are there restrictions on when investors can redeem their shares or exit the fund? What happens if an investor needs to withdraw their investment early? How does it make plan to handle liquidity events or wind-up scenarios? Another really good question that I think you'll hear often, especially for those that are newer to the industry, because I think the second everyone hears private lending, that's the first thing that pops in their head is issues with liquidity or
exactly. It's mortgages at the end of the day, right? So that's part of the game, but that's also why the returns are above market averages for the most part.
The big shorts just playing on the back of everyone's head.
Yeah, for sure. Okay, alignment of interest. How much of their own capital has the management team invested in the MIC? Great question, right? You want to know, are the managers of this MIC fully invested in this business? Do they believe in this business, or are they just using OPM, other people's money, to drive their business? What measures are in place to ensure the management team's interests align with the investors? Right? Great questions.
And then the final set of questions that we have on here are regarding market conditions. So how will the MIC adapt to changing market conditions, interest rate fluctuations, housing market downturns, just your preparedness for changes? Then the other thing is, what contingency plans are in place for economic slowdowns or shifts in borrowing demand? So also great questions. If you're someone who's investing, these are things you really want to consider, especially seeing what MIC offerings are out there. Not to talk bad about anyone else's, but there's some that would be very concerning to me if there was a downturn to the tune of like 3% in the housing market.
Yep. And this takes us back to, like, this is why it's important to investigate, like, how does this MIC diversify, right? Yeah. Like, what do they invest in? Do they invest in first mortgages or second mortgages? Do they do only construction loans, or like what space are they playing in? And are you comfortable with that investment strategy, right?
Yep.
So I think that's it, Neal. I think we went into pretty good depth on both the direct funding model and the MIC fund model. And really, at the end of the day, it comes down to the investor preference, right? What's your risk tolerance? What are your investment goals? What's the time availability of the money you want to invest in this, right?
If you've listened this far and you're considering investing, I got to say one thing, and you're like, you know what, I'm doing direct investing because so many of you that I've spoken to have said I'm going to do direct investing. I just want you to look at what you made on your direct investment and then stretch it out with all the empty months that you didn't have your money out and average that out and tell me what that return is.
Yep.
And then go look at what a MIC pays you and be like, wait a second.
Yep.
No risk, no work. And I could have made the same amount of money.
Yep.
Anyways, that's my take.
Love it, Neil. Good call to action there. Yeah. Obviously, if this is something you're interested in from an investment perspective, reach out to Neil.
Yeah.
Or if you're interested in starting your own private lending firm or MEC, please reach out to me as well. More than happy to jump on a call and talk about potential opportunities and ways we can help out there. So I think that's it, Neil.
No, that's 100%.
Thanks
guys.
everybody for listening.
Hey guys, it's Neal Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan McNeil. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549. And through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.